Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tashita Gupta, ACCA affiliate, and in this video we are going to be solving Shoe Company. Shoe Company, a shoe manufacturer, has developed a new product called the Smart Shoe for children, which has inbuilt tracking device. The shoes are expected to have a life cycle of 2 years, at which point Shoe Company hopes to introduce a new type of smart shoe with even more advanced technology. Shoe Company plans to use life cycle costing to work out the total production cost of the smart shoe and the total estimated profit for the 2-year period. Shoe Company has spent $5.6 million developing the smart shoe. The time spent on this development meant that the company missed out on the opportunity of earning an estimated $800,000 contribution from the sale of another product. The company has applied for and had been granted a 10-year patent for the technology, although it must be renewed each year at a cost of $200,000. The costs of the patent application were $500,000, which included $20,000 for salary costs of Shoe Company's lawyer, who is a permanent employee of the company and was responsible for preparing the application. The following information is also available for the next 2 years. This is the total revenue that we have. These are the sales, material cost, labor cost, total fixed production overhead, selling and distribution. Okay, so since these are common for year 1 and 2, we'll assume that this is the total, right? Shoe Company is negotiating with marketing companies with regard to its advertising campaign on another product, Smart Boots. Shoe Company is uncertain as to what the total marketing costs will be each year. However, the following information is available as regards the probabilities of the range of costs which are likely to be incurred. So these are the expected marketing costs. Which two of the following statements about life cycle costing are true? Life cycle costing should not be used by Shoe Company because the material cost per unit differ between the 2 years of the life cycle of the product. No, this is wrong. This is not a satisfactory reason to discard life cycle costing. Life cycle costing can take into account different material costs even if they differ in the 2 years of the life. Life cycle costing should not be used by Shoe Company because life cycle of the smart shoe is short and development costs too high. No, this is also not a sufficient reason to discard life cycle costing. Although these two are the remaining statements, so these have to be the answer, but let's still discuss. Life cycle costing should be used by Shoe Company because it will provide the true financial cost of producing the shoes. Yes, this is correct because life cycle costing shows each and every cost that will be incurred in every stage of the life cycle of the product. A higher price should be charged by Shoe Company from the start as the product will be unique. Agreed. So they have the patent for 10 years, even though they will have to pay the renewal cost, but then still they do have a patent for the technology, and as a result they should be charging high prices because it is a unique product. Moving to the second question, what is the total expected profit for Shoe Company on the smart shoe for the 2-year period? Okay, so since life cycle is going to be used, we are going to be calculating the entire costs and entire revenues, and then we will see how much profit is going to be there. Okay, this is the second question. Revenue total is given to me over here as $34.3 million. Then let's subtract the costs. First of all, we have the design and development costs, which were given right at the top, 5.6 million. Design and development, and these come out to be 5.6 million, right? And then we have the patent application costs. Next, patent application. So these are given to us at 500,000. So this will include the 20,000 also because we anyway have to incur this cost. So let me take it in thousands so that we do not end up making any mistakes. So this was million, so right, and similarly here also, right. Be very careful with these zeros because we don't want to be losing marks because of making a mistakes in such small things, right? Then we have our patent renewal costs, which we have to pay 200,000 every year, and we'll be how many years? For 2 years we'll be paying this cost. Renewal will be 200, 1, 2, 3 into 2 years, right? So this is my renewable cost. Then I will go for my material cost. Material is going to be costing me 16 in the first year. So 16 multiply the units by the first year, so this is 280,000, and add the 14. 14 is the material cost per unit in the second year, and in the second year we have 420,000 units. So this is my total material cost. Then I will subtract my labor cost. So labor cost is also given to me as 8 for the first year, multiplying this by 280,000, which is the number of units for the first year. Then for the second year, labor cost is $7 and the number of units is 420,000. Again, I will have my labor costs total for the 2 years, right? And then I also have my fixed production overheads, which are directly given. Fixed production overheads, right? So these are given to us as 3.8 million. So 3.8, and this is in millions, so I'm just converting it, right? Then we have selling and distribution costs, which is 1.5 million, again converting it to millions, right? So this is selling and distribution, right? With this we have listed all the costs. I believe there are no other costs. Okay, so these are the total costs. Sum it up. This will be, yep. Now our profit is going to be the difference between the revenue and our total costs, and this will come out to be 6,960,000. So we will just write that down. This is 6,960,000. This is our answer. Then moving to the third question. Further research has shown that there will be environmental costs at the end of the production of 250,000. Shoe company is considering how to account for these costs. Which two of the following statements about environmental management accounting are true? Okay, so there are additional environmental costs. Cost saving in environmental costs are easily identified. No, this statement is not correct, because identifying the costs of environment related activities is actually more difficult. Environmental management accounting considers financial costs only. This statement is also incorrect, because environmental management accounting will actually help you to generate and analyze both financial and non-financial information. So this is also incorrect. Activity-based costing can be used to analyze environmental costs. Yes, this is correct, because it will tell us that how much cost has been incurred because of which environmental cost activity that we have performed. Flow cost accounting is a recognized method of accounting for environmental costs. Yes, this statement is also correct. Moving on to the fourth question. Which of the following, what is the total expected value of the marketing cost for the 2 years on the smart boots range? Okay, so for this we have, these are the expected costs and these are the probabilities. The total has been asked, so we will take for both the years. Let's first find, this is the fourth question. Let's first find out for year 1. For year 1, we have 2.2 multiplied by 0.2 plus 2.6 multiplied by 0.5 plus 2.9 multiplied by 0.3. So this is the total for the year 1. Similarly, for year 2, I will put my figures over here. This is 1.8 multiplied by 0.3 plus 2.1 multiplied by 0.4 plus 2.3 multiplying this by 0.3. So if I add both of these figures, I'm going to get my expected value of the marketing costs. This is 4.68 million, which makes the answer option C. Moving on to the last question. Which one of the following statements is true if a decision is made using expected values? The risk is minimized for a set level of return? No. The risk is minimized irrespective of the level of return? No. The return is maximized for a given level of risk? The last statement would be correct over here. The risk is maximized irrespective of the return is maximized irrespective of the level of risk. Because what does the expected value do? It takes into account how much you will be earning, how much the return will you be getting depending upon the probabilities. So it does not take into account the level of risk, because it has not taken anything, if something is more risky or if something is less risky. It just simply relies on probabilities. So that makes option D the correct answer. With this, we have come to an end to this question. Please stay tuned for the next one. Thank you.